Brent crude, $98 a barrel. Today, June 3rd, 2026. But 2 months ago, it spiked to 138. What happens when it hits 150? First, let's be clear. This isn't a what if. We're already halfway there. The Iran-Israel war in February disrupted 15% of global supply through the Strait of Hormuz. The UAE just exited OPEC+, and the market is pricing a 1 in 4 chance of 150 by year-end. So let's look at history. The last 4 times oil broke through $100, 3 of them ended in U.S. recession. 1973. The OPEC embargo. Stocks fell 27%. Recession started 1 month later. 1979. Iran's revolution. 2 back-to-back recessions. 2008. Oil peaked at 147. The S&P collapsed 39%. Only 2022, the Russia-Ukraine spike, managed to avoid recession. So how do we get from 98 to 150? 3 plausible paths. Path A. Geopolitics. Iran-Israel re-escalation closes the Strait of Hormuz again, maybe permanently this time. United Airlines is already stress testing for 175. This is a fast spike. Months, not years. Path B. Supply discipline. OPEC Plus pulls another 1 to 2 million barrels off the market. Russia tightens. The UAE exit makes coordination harder, but not impossible. This is the slow grind. Could last all year. Path C. Demand surprise. China rebounds. India keeps growing. Global GDP beats expectations. This is the most bullish scenario for equities because earnings grow with the nominal economy. Now, the winners. Big Oil, Exxon, Chevron. Each $10 move in crude adds about $3 billion to free cash flow at the majors. Oxy and Conoco have the highest oil price beta. Halliburton and Schlumberger ride the capex wave. Tankers, Frontline, Scorpio. Hormuz reroutes mean more ton miles. More miles equals more money. Defense names, Lockheed and Raytheon, get a war premium if Path A plays out. And gold, plus Bitcoin. Stagflation is gold's home turf. Bitcoin doesn't have the track record, but the math is the same. Fixed supply meets inflation panic. Now, the losers. Starting with the obvious, airlines. Delta, United, American. Fuel is 20 to 30% of operating cost. At 150 oil, United's annual fuel bill rises by $11 billion. That's twice their best ever annual profit. Erased. Cruise lines double down on pain. Bunker fuel cost plus discretionary travel collapse. Trucking, diesel pass-through lag. Consumer discretionary. Anything you don't need will get cut first. And the Federal Reserve has a problem. Every $10 in crude adds about 25 cents to U.S. gas prices. At 150 oil, pump prices hit $5.85 a gallon. That's $140 billion sucked out of consumer wallets every year. Headline CPI goes from 3.3 to maybe 4.5%. The Fed's rate cut path? Gone. Bank of America already pushed the first cut from 2026 to the second half of 2027. This is stagflation, high inflation, slow growth, the same combination that defined 1979. And the only U.S. stocks that won that decade were energy and gold. So here's the trade. Long XOP or OXY for the upside. Long XLU and XLP for the defensives. Short XLY or airlines for the pain trade. And a sleeve of gold and Bitcoin as the inflation hedge. Kong's takeaway. Oil shocks don't always cause recessions, but they always cause portfolio shocks. Position now, or pay the spread later. If you want to trade these moves, Apex gives you U.S. equities, crypto, stocks, and commodities. 24/7. No KYC code FF50 gets you started. Link in description.